Okay guys, so I am a focused dividend growth investor. I'm all about building passive income and my portfolio is centered around that. But right now I need to rebalance. There are some holdings that have grown too big. I need to trim them down and I'm looking for things to buy. So I thought I'd make a video about my decision-making process. How do I find the stocks that I want to buy that fit my criteria and my goals? Hopefully you can learn a little bit from my decision-making process.
You have to pay attention to your money.
So the account that I'm looking to rebalance right now is my primary account. It's where I have almost all of my holdings, and I have 18 different stocks in there. And over time, some of them have grown to a little bit bigger than some others. So I have some that are overweight, some that are underweight. And basically what I'm looking to do right now is maybe trim some of those big positions. And at the same time, I'm probably going to add some more cash pretty soon, probably toward the end of the year. So as I do that, there's going to be cash freed up from the stock that I want to sell, plus the cash that I'm adding into the account. So I need to buy some things. So anytime I do this, I look at my watch list of opportunities, things that I might like to buy, and I take a closer look at those stocks that are at the top of my watch list. Plus, I look at the stocks that I'm holding that are currently underweight, because those are good candidates to put some money into so that I can bring them back up to equal weight. So it's always this decision between what do you hold now versus what do you want to hold to bring things back into a nice balance with a lot of diversification. So it's almost like tending your garden, right? You want to keep everything healthy, you want to keep everything growing properly, and you want to keep a nice even distribution here. So I enjoy that process. It's kind of fun. So I have a simple chart here showing the current relative values of the stocks in my portfolio. So you can see here that Canadian Tire is probably the top holding at the moment, and Magna is the other one. Both of these have grown a little bit. At the moment, I'm more interested in selling Canadian Tire though, because I really am uncomfortable having my biggest holding in retail. I'm not a big fan of retail. I'm uncertain about the future for it. And so in spite of how well this is done, and in spite of the fact this is a really good company, I'm not comfortable holding this much of it, and I really want to scale it back. I probably should do the same with Magna, but I'm not as interested in selling there. I think it's okay to leave that one where it is. So really, Canadian Tire is the one where I want to free up some cash. And as I add additional cash this year, I'm considering bringing up some of these underweight positions. So the ones here in red you can see are a little bit below the others. So that's definitely on the table, putting some more money into those guys to bring things back up to an equal weight. So before I get into that, I'm going to talk a little bit about the criteria that I use for stock selection. And I think really the important thing here is it has to be in line with your goals, right? So whatever you consider important to you in terms of your current investing time frame. Are you just getting started? Are you really close to retirement? Are you going to need cash soon? What's your risk tolerance? Are you looking for dividends? Are you looking for aggressive growth? Are you into small caps? You sort of have to understand all of that stuff in your entire picture to really define your goals and your criteria to build up that watch list and think about what are the candidate stocks that I want to buy, what actually fits my investing thesis. And this seems obvious, but you know what? It took me a long time to start thinking this way, because in the beginning, I was more focused on, I'm just going to buy the stock that is going to make the most money. Nothing else matters, right? But when you do that, you start finding that you're holding things that are not in line with your goals, right? They're maybe not the best thing for you to be holding right now. Maybe it's too aggressive. Maybe it's not aggressive enough. You're uncomfortable with the volatility, or you're uncomfortable how slowly it's growing. These have to be good fits for you. So that's something that I need to define here as I start looking at my rebalancing process. So I'm sort of on the latter stage of the investing time horizon, I guess. I'm getting closer to retirement. I don't know how close, but I'm within a couple of years probably. And so for me right now, I'm sort of in this position where my focus on dividends is shifting away from growth and towards yield and income, right? So I'm a little bit less concerned about that aggressive growth than I was in the beginning. And now I'm looking for real stability and a big high number in terms of the dividend income that I'm able to generate from that portfolio. Because I'm now at the stage where I'm measuring that dividend income against my expenses and my projected lifestyle into retirement, and I want to make sure that I have the right number to stay on track for that retirement plan. So that's a really key element of my goal when I'm looking at these stocks. Little less concerned about growth, and a lot more interested in yield. Now, that said, I still want and need growth in this portfolio, and that's especially true, I think, as we head into next year, into 2021. I think that given the situation, given the economic climate, given the fact that governments are going to want to spend a lot on infrastructure, they're going to pump some stimulus into the economy, both in Canada and the US. I'm sure the same is true in Europe. So I'm actually really bullish about growth prospects for next year. And so I'm conscious of the fact that I don't want to miss out on what I think is going to be some pretty darn healthy growth. So I don't want to discount that growth entirely. I'm still looking to capture a portion of what I believe is going to happen next year. I'm looking forward to that. On the bearish side, as I said before, I'm not very excited about retail, especially long-term prospects. I think that the typical retail model is one of these slowly dwindling sorts of businesses. There's so many headwinds that retail is facing right now that I'm not excited about owning it, and I'm certainly not looking to expand the amount of money that I have in any kind of retail whatsoever. So very bearish on that. And I think I'd say the same about energy stocks. I think the bulk of the energy sector is also, if not a dying business, then it's a rapidly changing business. I think there's so much happening right now with oil prices, alternative energy. There's all kinds of stuff there where you have these enormous behemoth companies that are trying to turn on a dime. They're trying to adapt to a new model. I don't know if they're going to pull it off. I don't like the volatility that's associated with the energy sector. And so I'm too conservative for that. I don't want to speculate and gamble on what's going to happen in energy. So those two sectors are basically off the list in terms of what I'm willing to consider. Okay, so my number one pick on my watch list that I'm looking really hard at right now is Andrew Peller. I love this company. I've been watching them for a long time. I'm excited about the diversification that this could add to my current portfolio because it's a consumer defensive stock, and that's something I don't own at all in my current portfolio. Back when I built up this holding, I couldn't quite find something in that sector that I really liked at the time, and I just didn't put money there. But now I'm looking at Andrew Peller. I like it. It's a completely new holding for me. I'm excited about the business that they're in. I think they did surprisingly well during the pandemic. For a company that sells alcohol into bars and restaurants that were hit super hard, they came through quite well. And I think that the solid planning and the conservative strategy that management had in place, it really paid off for them during this. So I'm looking back now at that time and thinking, wow, this is a solid company. They did well, and that gives me some confidence that they're going to continue to do well into the future. So I like that. I think, if you look at what's happened with Andrew Peller over the last year to 2 years, there's been a lot of reinvestment in the business. I think that's going to pay off. I think they're going to see growth from that, whether it's from acquisition or just organic growth in terms of where their business is at now. I think they have healthy growth ahead, so I like that. I'm not excited about the yield. It's lower than I would like. I am also not terribly excited about the growth prospects specifically for the yield. Management has shown a lot of a conservative attitude, I think, towards increasing the yield. They're not really big on paying out that dividend or increasing that dividend payout. But the actual prospects for capital growth, like I said, still look good. So I'm kind of being swayed in terms of looking at Andrew Peller in terms of the overall business, the health of it, and the growth prospects. And on the downside, I'm looking at that yield and going, do I really want to accept that small a payout? I'm not sure, but still, it's looking like a good pick. So my number 2 pick is QSR. This is the parent or the holding company for 3 major fast food brands, Burger King, Tim Hortons, and Popeyes. I like this company. I like all 3 of those brands. I think they're really solid. I like what has happened over the last while. Again, during the pandemic, they did well. The drive-through capability that those restaurants had really was a strength, and it brought the business through in a good way. You didn't see the dividend cut that you saw in some businesses in that industry, and I think they're healthy. On the downside, they had kind of a debacle recently with what they did to Tim Hortons. Management reacted really badly to the whole minimum wage thing, and they started cutting worker benefits. They drove morale down within that restaurant chain. It was all over the news. So I kind of look at that and think, wow, that was a really bad move in terms of what management did there. That makes me lose a little bit of faith and a little bit of confidence in their ability to execute and grow those brands over time. But really, that's the only black mark I can find about them. Other than that, I think the incredible success they've had with Popeyes is unbelievable. I would love to see them expand, into Canada with that brand. Hopefully that's something that will happen. I would love to see them make an acquisition. I think that could absolutely be in the cards, if they can digest some of the current growing pains that they've had. I think there's a growth prospect there in terms of that acquisition. I think too, there is an opportunity for them to handle this whole minimum wage problem that the fast food industry is dealing with through increased automation. Now, that's bad news for workers, but I think it could be good news for the bottom line in companies like this. I think that the management teams within these companies are going to see an increased push from this whole minimum wage problem into automation. I think it's going to drive them there faster than they otherwise would have went. And I like that for the bottom line in terms of profitability, in terms of streamlining operations, in terms of reducing risk from the sheer number of employees and employee-related issues. These are all good things for a business. So I'm excited about what could happen there in the near to medium term for that business. It's one that I really like. And finally, my third pick is BCE. This is one that I currently own, but like I said, and like you can see on that graph, it's underweight. I could definitely stand to put some more money in there and bring that holding up. I love the company. It is rock solid. It's a money machine, right? I mean, they have a really solid customer base. They have the ability to sell additional products into that customer base. I think once a telco like this owns a customer, there's all kinds of opportunities for additional products in terms of media, in terms of wireless growth. They do have to transition off these legacy landline business models, but I think they're doing that. I think they're putting that investment forward, and I think they'll be able to pull that off. It's almost like buying a bond. The company is that solid, the dividend is that solid, and the growth prospects are reasonable. So this is one of these cases where it fits my criteria quite well. The yield is healthy. I think it's going to keep growing. Growth prospects are fine, but again, that meets my expectation and really fits the goal that I'm going for right now. On the risk side, I think that BCE has a lot of debt. This is common in a capital-intensive company like this. They've leveraged debt in order to build out a lot of capital infrastructure in terms of the network. I think they're going to have to take on more debt with 5G. They've got a ton of upgrades to do within the wireless network in order to really drive subscriber growth. They're in a competitive landscape for that. The other big telcos in Canada are right there beside them, and I think there's definitely a race into 5G and to the services then that need to be built on top of 5G. They're going to need to borrow a ton of money to execute on that plan. That said, it's a great time to be borrowing money, right? Interest rates are fantastic. I think that's the whole idea with low rates. It's to encourage this type of investment. So I think the climate is good in terms of a company like this that needs to borrow money in order to fuel that growth. Now's the time to do it. So the debt doesn't bother me as much as it otherwise would. So basically, when I look at these top three picks, these are the ones that I've decided to put more money into. Now, how exactly I do that, I'm not entirely sure yet. One of the hesitations I have is that I need to fund those additional purchases by trimming these overweight positions. I'm absolutely committed to trimming that Canadian Tire position. I hate to do that though, because a large portion of that gain is unrealized. And if I sell any portion of that stock, I'm going to be looking at a capital gain tax bill in the current year. So I'm not happy about that. And I have to recognize the fact that that tax drag is going to be a hit to the overall performance of my portfolio. Now, that's the reality of investing in a taxable account. I have to accept that. But at the same time, I also need to be very aware of what it's going to do to my long-term returns. It would be fantastic if I could simply continue holding that stock forever and keep deferring that capital gain for a long period of time. But in this case, I think that the benefit of trimming that overweight position in a sector that I'm not comfortable with, that doesn't quite fit my goals as well as I'd like, I think it's still a good thing to do. So that said, I believe I will do that. I will free up that money, and then I will pick up this new position in Andrew Peller, and I'll put some of the new money that I have coming into that account shortly to bring up those underweight positions in QSR and BCE. That's the current plan. So guys, I hope this gives you some insight into a typical portfolio rebalancing sort of decision-making process that I'm going through right now. It's probably something that you will have to go through as well as you build up your portfolio, especially if you get into dividend-paying stocks, which I highly recommend. So guys, I'm going to make more videos on this topic. I am super excited about dividend growth investing. It's a way that I've been able to build a lot of wealth, and I think it's a super strategy for a lot of people. So if you want more videos on this, make sure you subscribe. Make sure you ring the bell so you'll be notified when I put up a new one. And I'd really appreciate it if you give this video a like. It is awesome and it helps the channel grow. Thanks so much, and I'll see you in the next video.